Owner of San Francisco's largest hotel, the Hilton Union Square, is walking away, surrendering it to the lender. Mr. Lender, Mrs. Lender, let's not be sexist. We're giving you the opportunity to take this once prime asset in San Francisco. That's a little close to the Tenderloin. We're giving you the opportunity to reimagine and rethink your ownership of this, not only as the lender, but we're giving it back to you. All right. Thanks so much for time spent here with us in this relationship. What's going on in San Fran with the buildings and all this stuff? Let's get into it. Here we go. A bit of bad news for downtown San Francisco arrived yesterday morning, Monday morning, with the revelation that the investment firm that owns the Hilton San Francisco Union Square and the Park 55 hotels are walking away from its debts and giving up hope on a return of San Francisco's convention market. Is it a hope, future hope, that of San Francisco's convention market that's driving all this? Well, yes and no, but the immediate issues are, we just don't have the foot traffic in San Francisco and people don't want to go there because of all the issues. What we often see is the term street conditions. And I always want to say, hey, there's probably nothing wrong with the streets. Concrete's fine. Asphalt's fine. It's probably mainly a bunch of concrete, right? That's what your downtown urban city streets are made of. Suburban, more asphalt because you just got longer roads and that whole thing, right? But what's wrong with the concrete in the streets? Nothing. It's what's on the streets that is just full of shenanigans, right? I mean, am I right? Virginia-based REIT Park Real Estate Investment Trust Park Hotels and Resorts has opted to cease payments on a $725 million loan, as the San Francisco Business Times reports today, essentially surrendering over 2,900 hotel rooms and hospitality facilities to its lender. This includes the 1,921 room, almost got 2,000 room hotel. That's the Hilton San Francisco Union Square, which is San Francisco's largest hotel, occupying an entire city block and one of the country's largest hotels outside of Las Vegas. Folks, this is an indicator of where things are heading. Park Hotels and Resorts is also giving up on the 1,024 Park 55 hotel, citing the continued debt burden of the two hotels on its portfolio and multiple factors that have made San Francisco market less desirable for their businesses. The less desirable part. So you've got that whole work from home thing going on, where in San Francisco, way fewer people have been going back to the office than other cities, than like Seattle, than like, any other downtown core. Downtown San Fran and downtown, actually Portland, have two of some of the slowest return of workers back into their downtown cores. And that's because street conditions. Yeah, the streets are not nearly what they used to be. And this one, okay, let's take a look at let's take just a quick look at the location of this. Here we go. This is all you need to know, folks. This is it. If you're wondering why, it's always proximity to the Tenderloin. Here is our hotel. That red dot, that red thing with the black dot in the middle. Yeah, that shows where it is. Here's the Tenderloin. Here's your sign. Now, so when you make an open area drug market, where you can sell damn near anything and buy drugs, sell drugs, stolen goods all day long, it doesn't make for an area where people want to go and rent a hotel room. Because if you walk around in this neighborhood, this is basically in the Tenderloin, right? It just is. Tough location, brutal location. So current owner is saying, I don't think so. I don't think we want this anymore. Real estate owners, real estate investment trust, they are tasked with making a profit from owning real estate, right? Real estate investment trust. Now, people dump money into the trust, get their return back, however the trust is set up. If you've got a hotel with a massive part of your portfolio, which I imagine it would be of this portfolio, being that it's one of the biggest hotels in the United States. You got debt of $750 million that they're walking away from. That's a sizable investment, right? A pretty good size investment. And when those assets are not performing at the levels that they should be, and you've still got the debt service, $750 million, that's not a good thing. You got some negative cash flow issues. You've got all kinds of issues. You've got future outlook issues. What's the outlook for commercial real estate? What's the outlook for the hotel and tourism industry in San Francisco? Well, nobody wants to come out and say, especially those folks in San Francisco, if you've been following this podcast, we are going through each building as it tanks. Any of the buildings that come up that are, fair game, all right, we're reimagining and rethinking our ownership of this. We're going to talk about, because this is the end result. Action here, end result here. That's what you got. It's not that hard to figure out. And yet you've got all these folks in San Francisco, politicians and voters going, it's not that bad. Well, the owners of the commercial real estate are saying something else. And the beauty of it is it's just business. It's not this emotional, we love San Francisco. We've been here forever. And we're so invested in our community and we love it. And we don't understand why other people are dissing our fine city. Well, because they can't make a return on their investment. In fact, it's a drag on earnings because you've got debt service. You used to have income come down like this. And I'm broadly generalizing because that's, it's what I do. But you've got this drop in revenue. And then if you have a short term or even a midterm or even a long term, hey, things are going to get better. We're going to hold on. But it's going the other way, right? It's going the other way. We're talking about hotels selling for a fraction of what they would a few years ago in 2019. And this one in particular, it's a massive hotel. And if you don't have the amount of tourism coming into the city because businesses don't want to bring their, employees, they don't want to have a conference at a hotel where just outside you have got some not good street conditions. We'll put it in their terms, not mine. Meaning dodge the human fecal matter game on the sidewalk. Don't want to deal with that. Don't want to deal with the open air drug markets. Don't want to deal with people running around fentanyl. Don't want to deal with crazy people screaming at the clouds as they go by out in front of your, 5-star hotel. That's the biggest hotel outside of the Vegas. People in droves, businesses in droves are saying, you know what? Yeah, we're going to reimagine and rethink our convention in San Fran, meaning that they're just not going there, right? And so at the end of the day, you've got hotels that are a fraction filled from what they used to be, and they can't make a go of it. And so they get to a point where like, oh, well, this is business. So maybe we bankrupt this corporation that used to hold this. We need to restructure our little REIT thing we got going on here. So after much, and so here's what the current owners who are giving it back to their lender. And this is pretty amazing. They're just like, no, we're not going to try and sell you. We're just going to let you take it back. Here you go. Enjoy. Have fun with that. 2 thumbs up. All right. Left the keys on the counter for you. After much thought and consideration, we believe it is in the best interest for Park stockholders. Remember, that's a real estate investment trust. Park stockholders to materially reduce our current exposure to the San Francisco market. Oh, I love CEO talk. I love it because it says everything without saying anything. What did he mean? All right. Best interest for the stockholders means get rid of that stuff. Get rid of it. It's non-performing assets. Get rid of it. So you're going to get rid of the stockholders' own that they don't want to materially reduce our current exposure. You used to want to have exposure to the San Fran market, right? Now, okay, we don't want to own there is what they're saying. We do not want to own there to the point where our CEO is going, please take this back. And this is Park Hotel CEO Thomas J. Baltimore in a statement. Now, more than ever, we believe San Francisco's path to recovery remains clouded. It's cloudy. It's murky We don't really know what directions things are taking. I think cloudy is an optimistic term for what San Fran's got going on, particularly in the commercial corridor, right? Because we've got commercial buildings all over the United States that are struggling because of this whole work from home thing and people not wanting to go back into the office. They recognize, oh, hey, now I got to commute. I got to pay extra for parking maybe. I got to go into an office building where they're telling me that, I'm going to have all this greater ability to network with my coworkers. And in reality, they're just going to go sit in a cubicle and do the same damn thing that they were doing at home for the last 3 years. And everybody told them, rah, 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 work from home, get the jab, work from home. It's all going to be great. Well, now, we're reaping the flip side of that, which is nobody wants to go back into the office. And there's a major pushback on that. And you know what? For a lot of these folks, I would say, yeah, they figured out how to make it go. These businesses figured out how to make it go during the pandemic remotely. And so now all this stuff is happening across the United States. But in San Fran, especially where a lot of these commercial buildings are in proximity to the Tenderloin, it's a hot potato. Oh, this is hot. We don't want it. Here, you take it. And that's literally what we got going on. But now more than ever, we believe San Fran's path to recovery remains clouded and elongated by major challenges. Elongated. What does that mean? It means you made it longer, meaning the challenges other cities are having, San Francisco's is going to be longer. Totally agree. It's going to be elongated by major challenges, both old and new. Record high office vacancy, new. Concerns over street conditions, old. Lower return to office than peer cities, new. And a weaker than expected citywide convention calendar through 2027 that will negatively impact business and leisure demand. So these hotels, they look at what the big conventions are that they've had in the past. San Francisco is just one of those primo cities, has been in the past, primo cities for major convention traffic, right? And I've talked with so many of you over the last few years that have been involved in that industry. And, everybody is saying, I'm not booking there. We ain't going there. Not doing that. We just don't want the exposure to our folks. There's tons of other cities that we can set up a convention in that people are going to be happy. They're not going to have to play the dodge the human fecal matter, not going to have to risk getting, robbed, all of this stuff. And I'm not saying that happens on the regular, but it happens enough. And it certainly happens in the Tenderloin. The mayor, London Breed, she's been very adamant that she's going to have a tough stance on open air drug use. Well, that's going to take some conflict resolution to get that squared away. Because where are those addicts going to go? And where are the people selling the drugs going to go? They're just going to move them around slightly, right? So you're still going to have that same impact in downtown San Fran. The underpinning causes of what you've got going on that are creating a lower return to office than peer cities, a weaker demand for citywide convention calendar. People don't want to go there. And that's the beauty of what I do here, is that I'm not just throwing stuff out saying, this guy's an idiot because of his policy and his opinions on this. I'm looking at business and going, this is a direct result. What is happening here is a direct result of policy impacting San Fran. You want to have an open air drug city area, Tenderloin? You want to have that? All right. You got it. Here you go. You want to have people selling stolen goods all day long. You want to have the violence. You want to have the theft. You want to have all the businesses closing down. Hey, you got it. You got it. That's all yours. But now you got to own it. And this is part of ownership, major ownership of commercial, giving it back. Yeah, don't want this. We thought about it, and it's not you, it's us, and we don't want this asset on our books anymore. It's a loser. San Fran is a loser. So what I thought was interesting was San Fran's path to recovery remains clouded and elongated by major challenges. And then he brought out what those challenges are. And some of those challenges are nationwide. Some of those challenges are specifically because San Fran has been run so poorly from a leadership standpoint by a bunch of politicians and district attorneys that don't know jack about the impact that it'll have on the city itself. This is one of those indicators. Really big hotel. One of the biggest outside of Las Vegas. Ownership. Yeah. We're going to have new ownership, and it's called the bank, right? As the Business Times notes, this marks a shift from 3 months ago when Baltimore and another hotel group CEO visited personally with Mayor London Breed and expressed some optimism about the future of the business travel market. You can have optimism all day long, and I encourage that. I'm more of a glass half full kind of guy, but I'm also realistic. You know what I mean? Long-term outcomes. All right. I hope that San Fran turns it around. It's an amazing city. It's got a lot to offer, but right now, street conditions, a little tricky, right? A little tricky. And I throw that out there as just a, massive blanket for all of the stuff going on that people in the business world and tourists don't want to deal with. Convention goers don't want to deal with, and they've got options. It's not like there aren't other options out there. Las Vegas being one of them, right? So, let's go to Vegas. We can gamble. The two hotels, as appraised in 2016 for the current loan, were worth a combined $1.56 billion. So you've got about a 50% loan to value ratio. Yeah, that's right. Because we were up at, what did we have for our debt? We had our debt at $725 million. All right. So, yeah, less than 50% loan to value ratio, right? What it's worth versus the debt you've got going on it. So it's a significant move that Park Hotels would walk away from debt that is less than half of that amount. And as one analyst tells the Business Times, it says that they are not optimistic that the business travel or convention and meeting business is going to return soon to downtown San Francisco. I believe we are on the front end of a ton of this happening because the long-term outlook, till you square away some of the underpinnings of what's making this, as undesirable as it is. And like I've said many, many times, till you start to look at the addiction issues that you've created by handing out everything but the drugs themselves, and then sometimes the drugs themselves too. We've done that here in Seattle. Till you look at that and analyze that from the standpoint of, all right, how's that going to impact our street conditions? Then you might have a better outlook moving forward. And these things all go in waves, right? We're just in a real downside wave right now. And I'm going to ride this wave with podcasts for literally probably months. This is what it's going to take. It's going to take a dumping out, a cleansing of the system. All right, that building we bought for that, and we got that much debt on it, and the occupancy rate is this, and looking forward, that doesn't look good. Get rid of it. And that's literally what ownership in so many buildings are probably looking at right now. And ownership of buildings across the United States in big commercial cities, in cities with a big commercial downtown. We don't need the space anymore right now. Moving forward, I still think we need less space than what we've got. And so much of that has to do with, if Amazon is struggling to get their employees here in Seattle back to 3 days a week, that means over a majority of the time, all that downtown commercial space is not being utilized. Now, it wasn't being utilized on the weekends before. You still got some restaurants and stuff going on, but for the most part, people aren't at their office in downtown on the weekends. It's a ghost town, right? You got some condo buildings and that kind of thing, and people that love to live there and love that urban thing. But the huge component is businesses and their employees in the downtown core. And that does not appear to be, just rocketing back to the way it was pre-pandemic. Part of the economics of San Francisco hotels, the Business Times notes, is the historic competition between leisure tourism and business travelers, especially the previously robust convention schedule, which meant lower vacancy rates throughout the year and higher than average room rates. In doing my research for this story, there was a lot of talk about price gouging in the San Francisco hotels, meaning, all right, you want to come to San Francisco? That's fine. You can rent a hotel. It's going to cost you $750 a room. I mean, that is not small chump change, right? That's a lot of money for a hotel room for one night, for the pleasure to walk outside of your hotel, walk out that front door and go, oh, we're in the Tenderloin. Oh, this is not good. You want to pay that for that experience? I mean, probably not. Most folks don't. So this also seems to point to the possibility that room rates will slide as well. Boy, you think? Yeah. Hotels across the city have been changing hands with some frequency in the last decade. And the latest news does not mean that the Hilton or the Park 55 will necessarily close. Somebody else will take it and they'll run with it. They will rework the debt because the bank's not going to run it. It'll run it for a while. They're going to resell it to somebody else because they want that asset off their books too. They want that asset to be performing versus non. And so they're going to try and spin it to somebody else. And then that person has to make the choice of, okay, I'm being offered at this price in a down market. I'm going to have to put this much money into it, or I'm going to have to do whatever to it to have this make sense. And then they're going to have to say, you know, our estimations of the marketplace moving forward, this is a yay or this is a nay. And it's going to be based on price, right? Because everything will sell. Everything will sell. Anything will sell at the right price. You might have to drop that price to get that bad boy gone. But that's something I talk about with my real estate brokers here at Summit Properties all the time is, it's not a matter of marketing. It's not a matter of how great a video you've got or how many Facebook ads you did. It's a matter of exposing that property under the right market conditions, but most importantly, at the right price. Because that's what people are concerned about, right? How much can I get it for? What are the terms? How much can I get it for? That's what people are worked up about. JP Morgan Chase, which recently took over San Francisco-based First Republic Bank. Remember that? That was the secondary bank after the Silicon Valley Bank. It's First Republic Bank. It got kind of its asset base, not asset base, but its depositor base rocked because it's a bank similar to Silicon Valley Bank. And, you know, it's in San Francisco, so it had a lot of exposure to the tech market. And so people are taking their money, depositors are taking their money out of the Silicon Valley Bank. And then they freaked out and they're like, well, our bank here, First Republic Bank, is kind of like the one that just went down. So they, you know, started yanking their deposits and it weakened that bank. And so JPM Morgan Chase was asked to step in and, now First Republic Bank under, you know, JPM Morgan Chase. So that will become the new owner of the hotels and may now seek out a buyer at a fire sale price. That's what will probably happen, right? Their banks aren't in the business of necessarily running this type of asset. That's not what they do. They lend out money, right? So they're going to want to spin this bad boy, get somebody in there, do what they need to get it moved on to the next owner. Last week, San Francisco Travel, the city's tourism outfit, launched a new ad campaign aimed at reviving the city's image in the minds of convention planners specifically. It's a real puff piece with what they're doing there, because the reality is, if you go to San Francisco, there are areas just like in Seattle where you don't have the shenanigans. But there's a lot of areas you do. And this hotel is in one of them, the primary one, the Tenderloin. Tenderloin is, you know, impact of the Tenderloin, proximity to the Tenderloin is often the major consideration when somebody's talking about giving an asset up. Less than a decade ago, San Francisco enjoyed one of the highest hotel occupancy rates in the country, hovering around 84% in 2015. That slid in the next few years and tanked in the pandemic because there wasn't any travel. There wasn't anywhere to go to and do cool stuff. There weren't any restaurants open. Venues, entertainment venues were not open. Everything was closed. So why would you go there? Well, I got to go there for a business meeting or whatever. Even that stuff wasn't happening because everything was happening on Zoom. And we were told 15 days to flatten the curve and get your job. Otherwise, you're going to lose your job. You know, we went down all those roads, right? And this is one of those impacts of, oh, wow, people got used to working from home and things got way worse during the pandemic because you didn't have enough folks in the downtown core and a lot of homeless people and drugs took over. And those situations, they just exploded. But San Francisco Travel said occupancy was back up to 62% in 2022, which is similar to what it was around the dot-com bust 2 decades ago. The agency noted that 35 events scheduled at the Moscone Center this year are set to account for 700,000 room nights at hotels. So you've still got a fair amount of tourism, just not the numbers to make the margins work for a hotel this size to its current deal. To its current owners and who run a real estate investment trust that, are basically stating, we're out of here. We can't make a go of it. So we've got this hotel. We've got a couple of other buildings. This hotel is interesting because it's a 2-for-1. You got kind of the 2 hotels there, which represent, thousands of rooms under ownership of these 2 complexes. You got this lender walking away, and then we've got other comparable sales in San Francisco that we knew what they paid. And sometimes, they're selling now at 40% of what they were valued at just a few years ago. We've got multiple examples of that happening now. In fact, let's see, what do we got here? Yeah, we've got another one here. Yeah, here is another podcast I'm doing today. Another downtown San Francisco office tower to sell at deep discount. You have to stay tuned because this one hasn't been released yet. But literally, this stuff is happening on the regular, and this is going to be a pattern for a while. So until San Francisco can kind of get a hold of their image and, just running some ads, it's like I talked about, just a few minutes ago, it's not a matter of what kind of marketing you do. We've got properties all the time that sit because they came on the market overpriced. Owners want too much money. Well, back in 2019, Zillow said it was worth, and they haven't recognized that we've had a drop in values because interest rates went through the roof. The Fed, jumped interest rates, and our mortgage rates have gone from 2.75 to 6.75 at one point there. Now I think we're down around 6.5 or 6.25, or, somewhere in that range, over 6 for sure. We haven't dropped below 6. So values have dropped, but a lot of these sellers continue to think, well, just a few little while ago, properties haven't dropped that much. And this is on the residential end, but we're talking some of the same characteristics going on in commercial here from the standpoint of you had a drop in values and you don't have the revenue stream on commercial to cover your mortgage. What do? You punt. Again, we're going to kick this hotel back to you in the form of a hotel, in the form of a punt. In fact, we're going to kick 2 of them back to you. You get a 2-fer today, JP Morgan Chase. So this is a situation that will not go away anytime soon. It will come back and things will change because they always do. People always want to say, it's just going straight to hell in a handbasket and you can't stop it. Well, things will occur that'll make this, spin back around, but I don't think anytime soon. Mayor Breed in San Francisco is talking tough on the open air drug usage, but what about the actual addicts themselves? Till you get some of these folks squared away and either into mental institutions or treatment centers, because treatment is housing, right? Till you start to go down some of those roads, you're going to have a bunch more of this stuff going on. I mean, this is not rocket science. If your hotel is located in an area where people are afraid to go to, which the Tenderloin is an area where people are afraid to go to, there's a bunch of accounts on like Instagram and Facebook and Twitter where they basically just show the crazy stuff happening in San Francisco. There's, a bunch in Portland. There's a bunch in Seattle. I mean, they just, they've got quick little less than a minute video clips. They've got these stories. Jonathan Cho is a perfect example. He does a great story in just a minute or two, showing exactly what's going on. That kind of thing, just the crazy, degenerate, drug addicted behavior on the streets of certain areas of Seattle is what people are not wanting to have their convention goers exposed to. Hard no-go, especially at $750 a night for a hotel room. Those folks are going to go, we're paying what for what? It's San Francisco. Don't worry about it. You'll be fine. And they're looking at the news going, all right, well, that news crew just got their van robbed for the second time. And that, wedding photographer just about was taken out during broad daylight for his camera equipment, and the list just goes on and on and on and on. So no matter what, marketing by the PR firm is not going to turn this around. The word is out that San Francisco's got major, major issues. Downtown Seattle has had major, major issues. Our mayor has cleaned that up a little bit. He's pushed it out to the peripheral, right? He pushed it out to basically the burbs and to industrial area in South Seattle, down Sodo, south of the Dome, south of the Kingdom. So if you push that away and you allow downtown to breathe, all right, there's a real argument to be made there. But this area here in San Francisco, I don't think anytime soon it's going to get cleaned up. And even if the mayor does, Mayor Breed does have a tough stance on open air drug usage, those addicts are still going to be out there, right? So all you're going to do is just be moving this around. So now you're going to move it to a new area. And then those hotels are going to have a tough time. Nobody's going to want to go there. So until you get a handle on the root cause of what you've got going on here, street conditions, I don't see this turning around anytime soon. And the whole work from home thing, how long is that going to take to drag people back to 4 days a week and then 2 or 3 years down the road? Say that's a year down the road. Okay, we need you guys coming back at 4 days a week. I'm saying Amazon's maybe going to do that. Then other smaller businesses are going to follow suit, right? Well, Amazon did it, so we're going to enforce you to do this as well. How long is that going to take? And those are all things that are kind of penciled in to the long-term outlook on revenue stream coming in to hotels in downtown San Fran, specifically in the Tenderloin, because most all of the restaurants and businesses that we've talked about, the Anthropology, the Nordstrom shutting down, Whole Foods shutting down because it was just such a shit show. I mean, all of these things have proximity to the Tenderloin, and they're shutting down because of street conditions, meaning there's, the streets are tough. They're rough. Feces, needles, tinfoil, drug addicts, stolen goods. People don't feel safe, going around. That is the opposite, the polar opposite of what corporate America wants to see in their convention centers. And up until now, I think San Francisco has been able to get away with it because, hey, look, we're San Fran. We're the biggest city out there for this kind of thing, right? Except with maybe New York, something like that. But that's East Coast. So we're talking biggest city on the West Coast for this type of thing. And now they're having to reckon with, our largest hotel just got kicked back to the lender. That's not good. Street conditions, not good. Hotels, big commercial office buildings selling for a fraction of what they were valued at just a few years ago. I mean, it's got some crazy stuff going on, and I will record it one podcast after another, because this is the end result of bad policy decisions that can be changed. But in a city like San Fran, I say good luck. Because a lot of what is happening here is what these voters wanted. It's what they wanted. So, you get what you pay for. Here's what you get. You got, ownership of one of the biggest hotels in the United States saying, oh, no more. Yeah. Hot potato. We don't want it back. You keep it. We're out. We're gonna, lose our down payment, whatever that was when we purchased it. We're going to lose our equity because moving forward, We're upside down. Our debt ratio and what we're paying on that debt is upside down, and looking forward, we don't see a way out. So here you go. And that's the beauty of commercial versus residential. Residential, people still need a home over their heads, right? So they will hang on to it even when it goes upside down 30, 35%, like some houses did during the Great Recession. And then they'll work it out. But if you are relying on cash flow to cover your payments in a commercial setting, you're not going to wait because you've only got XYZ cash to pay that negative. And it's a decision. It's a drain on your trust resources. You're going to bail. And that's what you've got. So I think you're going to have a ton of other lenders taking properties back, fire sales happening, lenders, deed in lieu of foreclosure, all of that stuff, mainly on the commercial sector. Because again, residential prices haven't dropped that much because you've still got a shortage of residential housing in most major cities. We just haven't built our way out of this shortage. And even with the interest rates going to the moon, sellers aren't wanting to sell on the residential side because then they got to buy, and probably in a high rate interest rate, environment themselves, because they're going to have to finance some of it. And so people aren't moving. And so prices have not dropped on the residential end that much. They've dropped from their peaks, which was a summer about a year ago, is when things really started to tank because the Fed made their move with the rates a little too late, in my opinion. But that's what we got. That's what we've got. So we're going to just keep covering this. So that's it for me on this one. Thanks so much for being here. I will catch up with you on the next one. Until then, do your thing. All right. We'll catch up then. Bye for now.